The other and third big thing is the step up in basis remains the same. And this is one of the biggest tax saving things that we have in our law. And this is another thing that the Build Back Better Act wanted to do away with. If you have an asset, let's say you bought your family home for $2 million, and then during your lifetime it appreciated and it's now worth $5 million. When you die, if your property gets a basis adjustment, the cost basis went from $2 million to now the date of death value, which is $5 million. So when the kids or the other parties inherit that asset, their basis is now $5 million. Most often it goes up, but not always. But here's the emotional trap. People say, oh, well, I've got $15 million, exemption. I don't need to do anything advanced planning. But people fail to realize that if you have $8 million today and you're in your 50s, you very well could have a taxable estate within 10 years. You're listening to Legacy Maker Podcast with Kristina Hess. Clear guidance for protecting your wealth, empowering your family, and creating a lasting legacy of generational impact. Legacy Maker, let's go. There's a saying that two things are certain in life, death and taxes. And the thing about taxes is the laws are constantly changing. And that is very true because last year on July 4th, 2025, the One Big Beautiful Bill Act was passed. I'm going to refer to that act as OBBA. OBBA. All right. Welcome to Legacy Maker. This is Kristina Hess, an estate planning attorney and legacy maker, and I'm so excited to bring you this legal update. Now, this episode is general legal information, and it's not tax planning. It's education only, and it's not giving you specific advice for your specific situation. All right, so starting in 2026, OBBA makes some major tax provision changes permanent. So let's talk about the estate tax. The estate tax exemption was going to sunset on December 31st of 2025, and now it is permanent. Now, we all know that nothing is permanent because Congress can always change it. But instead of sunsetting back to the pre-2012 exemption of $5 million per person, the estate exemption is now permanently $15 million per person. So every individual can pass $15 million tax-free when they die. The lifetime gift exemption is also $15 million. So you can either give it away while you're alive. You can give away $15 million while you're alive. But if you do that, it's going to offset against your estate exemption when you die. And then one of my favorite exemptions, which they wanted to take away a few years ago with the Build Back Better Act, they wanted to make it $1 million, but the generation skipping exemption, the GST as it's commonly referred to, is also $15 million. So it is not going back to $1 million. So what that means is in your multi-generational trust, you can pass $15 million or $30 million if you're married, and then that can continue down the generation tax-free. It's a beautiful thing. So that's permanent. The other thing that has not changed is portability. So what portability says is that if your spouse dies, you as the surviving spouse can save their unused estate exemption, but you have to file an estate tax return, commonly referred to as the number 706. You have to file a 706 estate tax return, elect portability, and save your spouse's unused exemption. So the problem with that is that you don't get to save the generation skipping exemption. So there is a way around that with advanced planning, but you need to intentionally set up the trust in such a way where you can file for portability and still get the generation skip. All right, so that's the good news. But three details matter here. The top federal estate and gift tax remains at 40%. So what that means is if you die, every dollar over the exemption is taxed at 40%. Uncle Sam gets 40 cents on every dollar. Portability remains available, as we talked about, but you have to make a proper and timely election on the estate tax return. The other and third big thing is the step up in basis remains the same. And this is one of the biggest tax saving things that we have in our law, and it's very valuable. And this is another thing that the Build Back Better Act wanted to do away with. And what that is if you have an asset, let's say you bought your family home for $2 million, and then during your lifetime it appreciated and it's now worth $5 million. When you die, if your property gets a basis adjustment, the cost basis went from $2 million, assuming there was no improvements or depreciation, $2 million, to now the date of death value, which is $5 million. So when the kids or the other parties inherit that asset, their basis is now $5 million. That's called the step up or basis adjustment. Now, it could also be a step down if the asset declined in value. So it's a basis adjustment. It can go up or it can also go down. Most often it goes up, but not always. But here's the emotional trap. People say, oh, well, I've got $50 million exemption. I don't need to do anything advanced planning. But people fail to realize that if you have $8 million today and you're in your 50s, you very well could have a taxable estate within 10 years. So a plan could fail in that situation if you don't do good tax planning. All right. You also want to make sure that your assets are funded and you've planned for incapacity and family dynamics. So even if the federal estate tax doesn't apply, you still need to do good planning. All right, so let's talk about some of the other changes. So that's the estate tax exemption and portability. The other thing affects children and grandchildren. Starting in 2026, there's these new accounts for children born in the United States after 2025 and before January 1 of 2029. So I believe children and some private donors have also stepped forward, but the federal government is going to give these new babies $1,000 in a tax-advantaged account, sometimes called a Trump account. So I believe you can go to trumpaccounts.gov and you can find out information about these new accounts. And then like your employers and other people can also contribute up to $5,000 per year. And I just saw last week on the news that some private donors are also going to be donating money to these Trump accounts. Dalio, different states, different wealthy individuals in different states are going to be contributing to the babies and children born in those states. So these Trump accounts are great because they can be used once the child turns 18, they can use the money for qualified expenses. Now, they're going to grow tax deferred, but I do believe there could be income on the growth. So that's something to watch out for. Separately, 529 plans have become more flexible. So for those of you who aren't familiar with 529 plans, these are education funds. And so parents, grandparents, really anyone can put money into a 529 plan, and they're the custodian of the plan for the benefit of the child. And that typically, historically, it was used for college education. But now they're more flexible and the funds can be used for K through 12 education, curriculum materials, tutoring, testing, dual enrollment fees, private education, and even certain therapies. So this is very advantageous for the kids. They're more flexible, and the annual withdrawal cap has increased from $10,000 to $20,000 per student for K through 12. There's no cap for college. So a super funding of a 529 plan, I've had grandparents ask me about this. Hey, grandparents get so excited. I have a new grandbaby. Should I, would I, could I super fund a 529 plan for my grandchild? And the answer is yes. So what you do is you take your annual exclusion. Now, your annual exclusion is the amount that the government says you can gift to anyone tax-free every year. So every individual can gift $19,000 to an individual every year for no reason at all, and it's 100% tax-free. The donor doesn't get a write-off, but there's no gift tax, which would be 40%. So they can gift $19,000 and it doesn't offset against their lifetime gift exemption. Parents could gift or grandparents could gift to a grandchild. They could super fund their 529 and they could do $38,000 per each grandparent per child for 5 years. So they could super fund, they could front load 5 years of payments, $190,000, and it can grow tax-free for that grandchild. Why would you want a super fund? You super fund because instead of doing $38,000, you can do $190,000, and then you've got 4 more years for the assets to continue to grow tax-free. So it just allows for one of the wonders of the world, which is compound interest, to work and allow that account to grow greater. And there's also more flexibility if for some reason, because sometimes clients will say to me, but what if my grandchild doesn't go to college or they don't use it? Then eventually some of the funds can be rolled over into retirement plans. So there's flexibility on the back end as well. So these should reflect grandparents' planning and consider the expectations that they have for their grandchildren and document it. Like, I'm giving you this gift, and these are some of the things that I'd love for you to be able to do. All right, wonderful. That's number one. And number two, the third big change is charitable giving. So the charitable giving rules have changed for people who don't itemize. So if you don't itemize, you don't have rental properties, you don't have a business, you don't itemize, you can now deduct charitable contributions, whereas in the past, only people who itemized could deduct their charitable contributions. So now single individuals can deduct contributions up to $1,000 and married couples up to $2,000. So that's a welcome change. But charitable contributions for those who do itemize, it's limited to 0.5%, or you have to meet the floor of 0.5% of your adjusted gross income before the charitable contribution is going to be deductible. But between you and me, 0.5% of your AGI, if you're not at least giving to charity over 0.5% of your AGI, then I really encourage you to do so. Not just for the tax benefit, so that you don't have to even worry about that 0.5% floor, but because we're blessed to be a blessing and you get to enjoy the feeling good of helping someone in need. Maybe you want to help the poor or water in Africa or your local church or congregation or synagogue. 0.5% is such a low floor. I really encourage you to get the benefit and the feel good emotions of knowing that you're using the blessing that you have and the wealth that you have to benefit other people. All right. 60% cash donations are deductible up to 60% of your adjusted gross income. This was from the 2018 law that was set to expire also, and it was now made permanent. So for families who give consistently, this can make sense whether you want to bunch your contributions in 1 year or you want to spread them out over multiple years. You can use a donor advised fund if you wanted to bunch charitable contributions into 1 year to maximize your deductions. So the takeaway is don't give less, just be intentional about how you structure your generosity. And then you have all the benefits, because for those who are generous, their world gets larger and larger. All right, number 4, business owners and investors. Now, this is my favorite change, and I want you all to say with me, can you say 100% bonus depreciation? 100% bonus depreciation for quality property that was acquired after January 19th of 2025 and placed into service after that date. So what does that mean? What that means is, let me give you an example. Let's say you bought a rental property in 2025. So you bought a rental property and you get bonus depreciation. What do you get bonus depreciation over? Your cost segregation. So with a rental property, you want to order a cost segregation study. And so then the depreciation schedule could either be 39 years or 27 years, depending on whether it's a commercial property or short-term rental, long-term rental. There's a different depreciation schedule. You want to talk about that with your CPA. But with cost segregation, you could say, well, the window coverings, the flooring, the lights, the electrical panel, these things are not going to last for 27 or 39 years. I need to depreciate them on a shorter, more accelerated time frame. That's cost segregation. So then a portion of the property that you bought is going to have items within the property that you're going to accelerate the depreciation. So you order the study, and then they're going to tell you, okay, you can depreciate this over 5 years. That's only going to last 5 years or 7 years or whatever. And then with 100% bonus depreciation, you get to write it all off in year 1. So this can lead to tremendous tax savings. If you had a really good year, you have a lot of income, you want to offset it, you're a real estate professional, then this is something that you could really take advantage of. This qualifies for eligible investments, equipment, machinery, technology, even certain vehicles. So this can really improve your cash flow and reduce your tax liability. So this is a really wonderful change in the law. And also Section 179, this is with regard to equipment and vehicles for work. If they're over a certain weight threshold, then you can deduct the whole thing. So if you had to buy a truck for your business, you could do bonus depreciation and deduct it all in year one. So the limit on the Section 179 went up to 2.5 million with a phase out beginning at 5 million. So those are all welcome changes. The qualified small business tax. So historically, what this is Section 1202 in the tax code. And what this did, if you were a founder and you started a business and it's a C Corp, it can't be an S Corp, it has to be a C Corp, but it was a C Corp, and you held that business for at least 5 years, and then you went to sell the business. And let's say you sold the business for $10 million, you could have $10 million of qualified small business stock that you sell, and there is zero capital gain. That means zero tax at the federal level. You're still going to have to pay your state tax, and that's where charitable planning could be very beneficial. But at a federal level, you had a $10 million pass. It was either 10 times your cost basis or $10 million. If your cost base is zero, you want to take the $10 million. Now they've changed the schedule. You don't have to hold it for a full 5 years. You could hold it for 3 years and get 50%. You could hold the business for stock for 4 years and get a 75% deduction. And then you get the 100% deduction at 5 years. And the maximum gain that is excluded increased from $10 million to $15 million. So it's gone up $5 million, which is a big leap. And that is very beneficial for those of you who are building a small business and you'd like to sell it someday. You're going to want to have that in a C corporation to take advantage of this. And there's also things that you can do to multiply this. And these are for business shares. The 15 million exemption or exclusion rather is for business shares issued after July 4th of 2025. So this affects how you want to structure the ownership and whether you transfer the interest during the life to others, or you sell it to key employees, or you sell it to a third party. All right, so that's the qualified small business exclusion that has gone up. All right, so for 2026, here's a practical checklist and some takeaways for your legacy planning. The first thing you're going to want to do is confirm the value of your estate. Now, remember, everything that you own is part of your taxable estate, including your retirement accounts. So that's going to be cash, stock, bonds, real estate, etc. And consider your gifting strategy and whether you need to restructure your trust so it's generation skipping. Review your beneficiaries on retirement accounts and life insurance. And maybe if you are going to have a taxable estate and you have life insurance, consider an irrevocable life insurance trust. That can remove the death benefit from your taxable estate. A lot of people think, oh, well, life insurance is tax-free, right? Well, it's income tax-free to the beneficiaries, but for the person who owned the policy and the insurance was on their life, it's part of their taxable estate unless it's in an irrevocable life insurance trust. So if you had a $14 million estate and $2 million in life insurance and you're single, then $1 million, and you died in 2026, $1 million of your life insurance policy, the federal government would take $400,000, 40% tax. Had you put it into an irrevocable life insurance at least 3 years before you died, that $2 million would have been completely tax-free. Heirs, $2 million. Uncle Sam, 0. So that's a really good thing to consider. Add it to your checklist. If you have children or grandchildren, revisit the 529 strategies. Consider whether superfunding could align with your goals and objectives. If you're going to have a baby, think about the Trump accounts and look at who may have contributed privately to augment those Trump accounts. If charitable giving is part of your legacy, and I hope that it is, then look at the deduction thresholds and make sure you're smart about that. And finally, If you own a business or you're an investor in real estate, make sure you look at the 100% bonus depreciation, Section 179, and whether you can take advantage of the new tax laws. All right, so that's your checklist. Those are the things to consider. It's been my pleasure to bring you the OBBA updates because remember, your legacy is subject to taxes, so make sure that you're smart about your planning. It's been attorney Kristina Hess, and I can't wait to see you next time. If you got value out of this, if you know a friend who's a real estate investor, be sure to share it on social media, subscribe on YouTube, give me your comments, let me know what you learned, let me know how you can benefit, because I want to see you make your legacy last. Thanks for joining me today. When you're ready to take the next step, connect with us at legacymakerpodcast.com. And until next time, stay wise, stay intentional, stay a legacy maker.